Today, we're going to talk about the best Asia funds to invest in. And the reason that we're having this conversation is because whenever we throw up this slide right here, people always have questions about the European funds or the Asian funds that we're invested in, both of which make up about 14% of our assets under management. So this chart here simply shows the breakdown of the money that we're managing across our various strategies. So you can see most of our money there, 60% is in Quantigens, that's our dividend growth strategy, and then another 13% is in our tech investing strategy, and the list goes on. Now these weightings will change over time just based on the values of the underlying assets, but the key takeaway here is that we're focused on looking at asset class allocation. Every single investor should draw a similar picture of where their money is so they can understand the risks that they're taking. Now, in this particular presentation, we were talking about replacing the gold that we have as an alternative asset, 1.6% of total assets, with something more relevant. For example, ARK's venture fund. Now, of course, we got questions about the Asia funds that we're holding, so that's what we want to talk about today. And before we get into Asia, we wanted to cover some basics. For example, active versus passive management. This is a very simple and important concept. So when investors give an asset manager money to manage, there's two contexts that can happen. The first is active, and that means that you're asking the money manager to outperform a benchmark such as the NASDAQ. So they're going to weight the assets in their own portfolio differently from the NASDAQ and hope that outperforms. That's called active management. And as we know, over the long run, 95% of asset managers can't beat a benchmark. So active management is, some would argue, pointless to pay fees for those services. Then you have passive management, which is much simpler, and it's about having an asset manager simply match the performance of a benchmark. And that's more difficult than it sounds, and they receive a fee for that. What you can see on the right-hand side here, this chart shows the fees for active investing, which are naturally more, as you would suspect, there's more work involved, and passive investing over time. You can see the fees are rapidly declining. That means that you should not expect to pay a lot of money for the privilege of having your assets managed. And what happens there is when you have scale, when you have an asset manager who has a lot of money, they're able to charge very low percentage fees and still make plenty of money to be able to manage the fund. So when we look at ETFs, exchange-traded funds versus traditional funds, you should always invest in ETFs because they're typically, let's say, ETFs like Vanguard are some of the lowest cost investment products out there. And low fees are very important over time. So the longer that you plan on being in the market, the more that fees can impact your investment. And we'll talk about that. Now, for many investors, the primary exposure they have to funds would be in 401k plans run by their company. And these are usually put together by Gwyneth and HR, who is easily sold whatever tripe some salesman is trying to sell as opposed to quality investment products. And there are companies out there that have made a business around simply helping 401k investors see the fees that they're actually paying because there are lots of hidden fees in various investment products. So let's go ahead and talk a little bit about what we call here the Asian problem. This was taken from a presentation that we did on diversity, equity, and inclusion, which damages shareholders. And we had pointed out that nearly 60% of the world's population can be classified as Asians, and that's what the DEI folks do, and it's flawed. Here on the right-hand side, you can see all the countries in Asia. It's a very diverse place. So when we talk about investing in Asia, we need to consider that there are an awful lot of countries to be considered, so we can turn to a company like MSCI, which classifies the world's countries into buckets, what they call developed markets, like the European countries there, Canada, United States. Then you have emerging markets. BRIC would be the most traditional: Brazil, Russia, India, China. Then you have frontier markets like Bangladesh, Pakistan, Vietnam, and then standalones you see alongside there on the bottom. Now, in looking at these various buckets, we need to consider where we ought to be getting investment and exposure. And the first thing that's quite interesting is that here's a look at MSCI's breakdown of emerging markets and the various country weights within. So you see that they have China. Okay, that makes sense, right? China and India are two BRICS. But look here, we have Taiwan and South Korea. Well, that's rather odd, because if you've ever been to either of those places, you'd realize they're far from being emerging markets. They're very developed. Why is that? Well, that's because MSCI uses a particular methodology that considers risk. So, for example, you have North Korea there. The DPRK is certainly adjacent to South Korea and presents a risk. So that's one example of why they might classify South Korea as an emerging market. So when we start to look at ETFs that are built around these indices that give us Asian exposure, one very popular ETF out there is Vanguard's Emerging Markets ETF, VLO, and here you can see the weightings for that. And not surprisingly, Taiwan is up there alongside China. And this particular ETF only charges 8 basis points. That's 0.08%. It charges so little. It's just remarkable how low fees they can charge. Why? Because they have so much assets that they're managing that they can get away with charging very small fees. So when we look at investing in Asia, we want to choose ETFs that charge the lowest fees, and Vanguard is the lowest cost provider of ETFs out there. Now, when we consider an ETF, we have to consider the underlying index, and for global indices, there are two players, MSCI and FTSE. I worked for MSCI for a decade, so I'm quite familiar with the idiosyncrasies between these two companies. And a big one that we got a lot of questions on was that FTSE reclassified South Korea as a developed market, but MSCI continued to classify it as an emerging market. That's a pretty big difference in methodologies, and we get a lot of questions around that. And that difference can contribute in a great way to the performance of indices. So, for example, after China, South Korea is the second largest component of the MSCI Emerging Market Index with a weighting of 15%, while in the FTSE Emerging Market Index, South Korea is not present. So when you consider what ETFs you want to invest in, you need to consider that the methodologies behave differently and focus mainly on fees. So there's some questions that would start to arise, and it starts to become very complicated. So how do you feel about being overweight Japan? So if you simply chose developed markets, you'd be heavily overweight Japan and Asia. If we looked at emerging markets, would you prefer to be overweight China instead? Are you even in a position to make that call? Because there's a lot of decisions you can make here when you start considering all the different indices out there. There are actually more indices than stocks. So instead of focusing on trying to generate alpha to outperform, perhaps we should just focus on the diversification effect that we're getting from these funds. And that's what we look at. And this particular tool is on MSCI's website. It's very rich. It allows you to see how countries are correlated to one another in terms of performance. So if you look on the upper left and lower left, you can see, well, Canada is correlated to Canada. That makes sense, right? It's correlated to 1. That means if you took the performance of Canada and compared it to its own performance, they would be exactly the same. And then below that, you see, you could start, well, you've got the performance of USA versus Canada. Well, they're neighbors, so we would expect these two countries to, and trading partners, key trading partners, we'd expect their performance to be similar. So when you have a red dot, that means that the two countries may even be negatively correlated. And what's remarkable here to see is how Pakistan, if you look on the left-hand side, about 3/4 of the way down, there's a red bar that extends across to the right. And then upwards, you can see how Pakistan is extremely uncorrelated to the rest of the world. So when we think about investing in Asia, we're doing so because we want the diversification effect across our broader portfolio. Now, if you're a younger investor, you really need to consider how fees will erode your returns over time. So the longer that you sit in the market, and as a young investor, you'll be in the market for quite a while, hopefully before you start taking out your money, the more that you'll lose from fees. There's actually a compounding effect there, and that makes sense. Longer you stay in, even with lower fees, let's say they're using the 2% example here, you can lose a lot of your money to costs. And this particular example here, this is from Vanguard, and look at that. At the bottom there, it says the industry average expense ratio, think about that as fees for a fund or an ETF, is about 0.5%, so 0.49%. Vanguard's average expense ratio is 0.09%. Remember, the example we gave was 0.08% for their emerging markets ETF. And here they show you, based on the initial investment amount, how much you'd be paying in fees over the years. So the value in bold there is the savings. So 30-year savings for an investment of $500,000 would be around $300,000 when you compare the industry average to Vanguard. So we would suggest that investors only look at the lowest cost options out there and keep it very simple. So here we've taken what comes down to Vanguard's emerging and developed market ETFs. Both charge 8 basis points, very cheap. You can weight these. So you weight 33% on the developed market and 66% on the emerging market. And look what you get here on the right. You get this nice breakdown across all these different countries that provides you with some relatively even exposure and a nice mix. That's easy enough to do. You can re-weight these, let's say, every year. And it's a simple way for you to get cheap exposure across Asian countries. Now, when it comes to our own exposure, we're doing something different. We've talked about this before. So we have money that's domiciled in Hong Kong, and there are reasons for that. So we've mainly done that to avoid systemic risk. And it's not easy to open up an account in Hong Kong and deposit money and have somebody manage that. And I worked there. I'm a Hong Kong resident, so I'm able to do that. Most people wouldn't be able to do that. And one of the benefits is that I can get exposure to some companies without having VI structure risk. And I'll put a link to a presentation we did on the risks in China so that you can read all about those. But what we ended up happening is that we have this collection of funds that are provided by aliens that charge at least 1%. That's unfortunate, but it's a fee we're willing to pay to have that money domiciled abroad. So our decisions and our tolerance for risk and the risks that we're looking at will differ from everyone else, but we would, if we didn't have that to consider, if we weren't able to domicile those funds abroad, we would be using the exact same strategy that we've covered today. So just to conclude, pay attention to the impact of fees on your horizon. So always go with the lowest cost providers. That will make a big difference in the long run. Look at the diversification effect, not the alpha. You want the investments that you're making in Asian funds to help offset the rest of the assets you have under management. Focus on the lowest fees. Don't pay for active management when 95% of asset managers can't beat a broader benchmark. Just let someone else decide what geographies you ought to be invested in, because MSCI and FTSE will make various decisions at different times. As you can see, when we talked about Russia, right? They are moved out of Russia, and then they'll look at South Korea differently, whether it should be an emerging or developed market. So the easiest way to move forward is to let them decide the geographies and do all those calculations, while you simply allocate your money across 2 low-cost ETFs, and Bob's your uncle. So please put your comments in the comments section. Make sure to subscribe to our channel. Thanks so much for taking the time to listen to this today.